Okay, guys, today we have to discuss the compliance with accounting standard. And by accounting standard, we mean IFRS GAAP. And why we need to comply with this accounting standard, these accounting standard. The reason is that, these accounting standards like IFRS and GAAP ensure consistencies. It also ensure compatibility, and it's also ensure reliability and financial statement, right? So compliance actually reflects ethical responsibility to stakeholders like investors, like regulators, and the public. Okay. Now, when you're compliance with the accounting standard, then it means that it's reflect your ethical responsibility to the stakeholders, which may be investor, regulators, or the public. Now, if you are not compliant with accounting standard, then this will risk of misrepresentation, legal penalties, and you may say loss of trust. So the ethical duty is that management must apply standard objectively, avoiding manipulation or personal or corporate gain. For example, adhering to international accounting standard that is IS1 that related to the presentation of financial statements. So if you are adhering to the IS1, then that will ensure a fair presentation of the financial statement. Now, if you see here, incorporated businesses must file financial statement with relevant authorities. Company directors ensure compliance with the company legislation, GAAP, IFRS accounting standard. Deviation from accounting standard occur, they must be disclosed with the reason. And if you are not disclosing, then that means that this is the risk of misrepresentation, legal penalties, and loss of trust. Right? Now let's move on. Accounting choices and their impact. So accounting choices and their impact, you know that standard upon allow flexibility. For example, a depreciation method. As you see, there are four methods in depreciation. Fair value was cost model. So I'll write here that there's a flexibility and depreciation method, fair value versus cost model, right? So choices impact reported profit. Mean the report may goes up or down because of the choices you made. So it also affect there's some impact on asset values and key ratio. For example, if you look the two method for inventory, that is FIFO versus LIFO, last in first out, then that affect inventory and cost of goods sold, right? So the ethical issue here is selecting method to mislead stakeholder, mean boosting short-term profit, violate the integrity. So when you are choosing or selecting method that mislead the stakeholders and you aim at just boosting your short-term profit, then this will violate the integrity, and this is the core principle of ethics, code of ethics, right? Now, impact on user. Investor may misjudge performance and creditor may misassess risk. So this will affect and this will have impact on the user. So professional judgment must align with the spirit of standard, not the exploit loopholes, right? If you see here, the regulatory environment allow choices in financial reporting. For example, I-16 property planning equipment allow cost model regard asset at the original cost. Revaluation model adjust the asset value periodically, right? Now let's move on. We have to discuss why disclosure. Why disclosure matter? We have discussed previously that if you want to get some deviation, then you have to disclose it. Then why disclosure matter? Full disclosure ensure transparency. Full disclosure will ensure transparency and key to ethical financial reporting. IFRS, mandates that IFRS 7 require risk estimates and judgment to be disclosed. Protect the stakeholder from hidden liability or overstated asset. So ethical lens here is withholding material information breaches accountability and fairness. So you have to disclose. If you are withholding material information, then this will breach accountability and fairness. So you have to disclose. Okay, this is one of the things. If you think from the perspective of ethics, and if you're looking from ethical lens, then you don't have to withhold material information. Now, build trust. Market rewards company with a clear, honest disclosure. So when you are disclose the things, the material things, then you will build trust in the market, and the market definitely reward company with a clear and honest disclosure. So this means that you have to disclose. This will help the user, and the if you see here, help user to make informed decision. Like shareholders decide to buy or sell the share, supplier decide to offer goods on credit, banks decide to approve loan. So these are the things you have to ensure that the material information should be disclosed, and this is good for transparency and accountability and fairness. Okay. Now, if you see here, the ethical and professional judgment require that accountant must accurately represent economic activities, deciding whether an expense should be capitalized or expenses. There's a standard related to this, that whether you should capitalize the expenses, or by capitalize we mean that you make it a part of the asset, or you make it a simple expense. Now, assessing asset impairment to prevent the misleading profit, you have to assess this another standard, that is IS 36, which treat the impairment of asset. Now we have a case study. The case study is the General Electric share plummet after whistleblower Harry Marker follows expose accounting profit. Now, first let me tell you the background that in 2018, the General Electric faced allegation of accounting fraud for the whistleblower named Harry Markopolos. And issue was that accused of hiding 38 billion in losses, particularly in its power and insurance division. Now, the accounting issues was that allegedly used aggressive revenue recognition and understated the liability, and that is the violation of IS 37. So the disclosure failure means omitted the critical detail on long-term care insurance risk and cash flow issues. So the impact was stock price crash, that stock exchange CEC investigation launch, and 200 million penalty paid in 2020. Okay, so the ethical breach was lacking of integrity and transparency, mislead the investor and regulator, and the lesson was robust compliance and disclosure could have mitigated the damage. So if they have not hired the things, then they will not have to face the penalties. Now, this is the report of 175 Fitch, and this is hiding financial troubles, and I have told you that they have aggressively overstated the revenue and understated the liability, and it needed higher insurance reserves. Accounting issue was were presented in its oil and gas unit, which I have told you that is related to the power and insurance division. The estimated fraud was 30 billion, and it is just tip of the iceberg. And that time they have paid in 2020, they have paid 200 million as a penalty, right? So the report was shared with the security regulatory laws enforcement. So the lesson was misleading financial reporting can result in severe consequences, lawsuit, loss of investor trust, and stock crashes. So this is all about the compliance with the accounting standard, accounting choice, and their impact, and why disclosure method. Okay, thank you for watching.